Good morning. You're watching The Market right here on ET Now, and we're coming to you live from the ET Now Motilal Oswal studios. And what a rough week we're coming out of. On Friday alone, you had that vicious 400-point fall, and we even dipped sub that 22,200 point in the previous week gone by. And yeah, the FI is selling irrespective of the MSCI inflows. That also continues at a very, very relentless pace. So, hoping that a bottom may be closer.
Fingers crossed. Last week was, it was a painful week, and whichever way you look at the market or any data point in terms of the market is clearly indicating that the pain right now is quite excruciating. In percentage, it may not be a large fall, but when it comes to the carnage in the mid and the small cap space, I think the selling was unexpected. The selling happened without any news flow, without any disturbing global cues, nothing on the local front. It is pure selling, lack of buying. Everyone is desperate to sell. The desire to buy long seems to be evident, and we are going through that patch of the market where pure liquidation and liquidity commitment seems to be evaporating. So a tough week. Hopefully a better week, because if you look at the global cues in a sense are not that bad, which is that Asian markets are stable. Nothing negative has come on the tariff front so far. It appears that the risk of fear which was there on Thursday and Friday in terms of decline in crude, decline in Bitcoin, all that seems to be settled. So the selling, I think, was very isolated without any reason. It was pure panic.
Yeah, it seems like it was pure panic because even right now, not just the handover from the US equity markets on Friday, but even the US futures are hinting at a little bit of an upside. So it was a big turnaround actually. The Nasdaq managed to hold out about almost 300 points. The S&P 500 index also almost closed in on that 100-point gain, and it was a solid 600-point move coming in from the Dow as well. Bitcoin, yes, it's cooled off, and surprisingly, gold as well has seen a bit of a dip coming in, almost 2% or so. I think what really took focus all through the weekend was the kind of unprecedented showdown that you had at the Oval Office between, Zelensky as well as Trump, and the kind of commentary and the kind of, sort of cold vibe that they shared between each other. Trump, of course, saying that, you've allowed to be yourself in a very bad position. You don't have the cards right now. With us, you starting to have the cards. And yeah, Zelensky only sort of defending himself, saying he's serious, that they're the country which is currently at war, and discussing all those issues. So that said, the global markets were okay. All that investors are now waiting for is really that March 4th tariff deadline. And I don't think for the global equity markets, there is a bigger trigger than that. Having said that, a bit of a reprieve, because it almost hints that US is now sort of aligning towards Russia as opposed to Ukraine. And the intention seems very, very clear now to call off this extremely long-drawn battle between both Russia as well as Ukraine. Asia as well, holding up pretty okay this morning. You've got most of the markets up in the green, much unlike Friday. So you've got a 1% move coming in on Japan, equating to about a 400-point move. Hong Kong has seen a big reversal, 345 points higher, and even China is holding up a solid 0.6%. And guess what? Even the Nifty implied open is indicating a positive start for us. So seems like we're headed in, at least to start off trade, a little bit of a rebound coming in. But yeah, can't sugarcoat the pain that we're coming out of from, and especially the kind of knock that we took when global markets had a shake-off. I mean, one would have thought that because we've fallen so much, if the global markets were to fall, we may perhaps not fall as much.
See, the Friday's price action was little bit global and lot local. The selling, in a sense, is now getting brutal. And you cannot associate a reason or a factor to it. It is just that the selling now seems to be getting brutal by foreign institutional investors. That's one. Second, where do we go from here? I think March would be a better month. And the reason why March would be a better month is because you've had the longest losing streak for the market in last 20 years. All technical indicators bounce. So bounce is coming, both in terms of technicals and in terms of what the global setup is. Locally, things are not looking that bad, which is the high frequency data. What are the data points we look at? GDP print has become better. Auto sales numbers are not that bad. The other high frequency data point is GST tax collections. That's also not that bad. So if you add up all the high frequency data point, there seems to be clearly a bottom in place. Now it is time wise and price wise pain which we will have to go through. It's very simple that Indian markets are not going through a fundamental crack. They are going through what could be called as PE derating, and that may continue or that may not continue. But I expect that March would be a better month than Feb, and hopefully the process of rebuilding in terms of finding the real value in individual stocks and market bottom is around the corner. But if the selling intensity continues without any reason, then it's difficult to fathom. So I think the concerns for the market are not fundamental, they are technical, and when things go in this technical whirlpool, so to speak, it's very difficult to establish that how much more or how much less. Because if you buy now and if you should sit patiently on stocks, I think you would be rewarded in course of time. I think we are reaching those levels now.
Yeah, and the GDP numbers as well, the fact that we've managed to clock 6.25% was definitely a lot better than what the street was penciling in, and definitely a lot better than the previous quarter. Also hinting towards that FY26, it's going to be an upward trajectory. And more importantly, you know, the growth figures, I mean, let's be fair, they're better than any of the developed or other emerging markets, the GDP numbers for India, that is. But let's take the conversation forward. Where is the world headed? Matt Orton joins us on the show right now. Matt, hi, morning. I know the street is all obsessed with that April 4 deadline for tariff implementation, but first let's talk about what happened between Zelensky and Trump, because you really were on repeat mode playing that video out. You couldn't get your eyes off that. What is it hinting at? Does it seem like America is somewhat aligning towards Russia now?
Hey, good morning. It's always great to join. And I think Trump ended that whole segment great by saying, if anything, this is going to make for good TV, because I think it did. And we're all talking about it. But to be serious about what it actually means, I think, you know, to look at it from two different perspectives. From a geopolitical perspective, I think it highlights that Trump is very serious about finding a way to end the war. I wouldn't necessarily say he's moving more towards Putin, but if listeners took in the whole 11-minute segment that actually took place, some of the words that Trump used were really signaling that you can't basically beat up the person you're trying to make a deal with. And I think that's exactly what he's signaling about Putin, is that someone's going to have to give up something in relation to this. And hopefully there's going to be the security guarantees in place, which is why you've seen European defense companies continue to work so well. And so for me, I think it adds a little bit more uncertainty into the near term with respect to when we might get this sort of ceasefire. But I think based on the rhetoric afterwards as well, that we're going to continue to work towards it. It is not an easy process. But for me as an investor, I think what it says is it really highlights why sentiment has been so negative, not just in the US, but around the world. And it's because there's so much uncertainty from a geopolitical perspective, from an economic perspective, from a breakdown in different pockets of different markets. I think we're all digesting what that means. But overall, just like we're probably going to get a deal, markets are probably also going to remain on good footing because growth fundamentally continues to look good, particularly in the US.
So, Matt, do you expect some clarity really to emerge in the month of March on the tariff front? Do you think word would know that what the final tariff plan would be?
Yeah, you know, Nikunj, I think we're going to find out on Tuesday how serious we actually are about implementing these tariffs, and whether or not all of the tariffs on Mexico and Canada are implemented at the full 25% level on Tuesday. I think what's more important is where we're going to be 1 week or 2 weeks down the road, because we all believe and hope that these are going to be used as a negotiating tactic to kind of level the terms of trade between the two nations. That's what the markets are pricing in as well. So I don't know if we can use what happens in the next week as the signal to where we ultimately end up, but I do think we'll know much more before the end of this month. So I view March as really a clarifying month. We're through earnings season. We're going to have the FOMC. Markets are going to have to hold up in light of macro uncertainty. So I think if the markets can digest bad news in stride and rally on good news, I think that's going to set up a very constructive picture for this bull market really to start to reaccelerate. And if not, I'd rather have more of a washout very, very quickly so we can continue to rebuild the bull market. Because at the end of the day, like I alluded to before, markets go up because of forward-looking earnings. And when we look at the earnings for the US and many other parts around the world, that is still looking positive. That still remains in place. So I'm still biased to be bullish over the long term.
Matt, in the interim, while investors do await clarity on tariffs, you think markets are going to be on the sidelines, or are we going to see investors load off and go light into this announcement or clarity?
Yeah, we saw a little bit of that last week. I mean, I'm encouraged and also discouraged by the price action last week. Thursday, in the wake of NVIDIA's, I would say, fairly good earnings, NVIDIA over in overnight hours was up, and then it ended up down more than 8%. But what was most concerning to me on Thursday was that we saw a spike in correlation. This market has been held together, at least in the US, because of healthy rotation beneath the surface. While the Magnificent Seven, in general have rolled over a little bit with the exception of Meta, the rest of the market has been working really, really well. Financials, energy, industrials, consumer staples, utilities, all of those sectors have been working quite well, but everything went down on Thursday. We saw a rally on Friday back. That's encouraging, and we have to see more of that going forward because that sort of increase in correlation, we're susceptible to those air pockets right now because sentiment is so negative. And once a bid comes out from the market and no one's there to buy, you'll see the market start to go down in that sort of death spiral. I don't think we're going to see that, again, because sentiment is so washed out. There's a number of indicators that are very, very washed out. So I would expect to see the markets take news in stride because we're getting clarity, and markets like to have clarity going forward.
Oh, yeah, they do. Matt, great to have you on the show. Thanks for your time as always. And we're going to get further clarity. Guess who? None other than Chris Wood from Jefferies is going to be joining in to talk about trade wars, the dollar dynamics, FIF flows, and more. We're going to make sense of the global chaos. And more importantly, back home, when will the FII sell-off reverse? And does it need to? Can the DIIs, as they had been past year, pull off on their own? Is it time to buy or stay on the sidelines? How is it that you should be positioning your global portfolio? We've got the ultimate voice joining in today at 9:30. But let's talk about how the day is going to be. Seems like we're headed in for some bit of relief. You've got Kunal joining in on the show right now. Kunal, day after that absolutely freaky Friday. I don't know which better way to describe it. What do you think is in store for us, given that global markets have seen a bounce?
Yeah, it was a tough Friday for many market participants, but I think we were discussing this, that sub the 23,000 mark, 22,800, the markets are bound to get back into a corrective phase. The correction was more accentuated, because of the way mid caps and small caps they managed to sell off on Friday specifically. But there are very interesting data points now. For example, 92% of the stocks in the mid cap 50 and the small cap 50 are now trading below their 20, 50 and their 100 moving averages, and almost 88% are trading sub their 200 moving averages. These are steep data points when we look at this in terms of the market breadth, market positioning, and specifically in terms of the sentiment across the mid caps and small caps. And then almost 88 to 90% of the stocks on the Nifty 50 are also trading below their these three four key moving averages. The put call ratios are oversold. We've seen the Nifty RSI also coming back into a deep oversold territory. So these are very steep and exceptional data points. We don't see this regularly in phases of market direction, but maybe I think we could probably be at a point where the markets at 22,000, 22,100 could establish a near-term support, and we could be looking at for a decent bounce over the near term.
Okay, Naresh, play for the bounce, or the selling is just going to get further accelerated?
So there could be a play for the bounce. We've seen a large take, and many a times we've seen the last day of the month where there is a lot of flow shift also becomes a bottom. So yesterday's low becomes a stop loss for a trade today.
Okay, let's talk stocks then. Kunal, what kind of bias would you have? Large cap and all buy?
Yeah, large cap and all buy, and at least looking at the way markets are positioned, the GIFT Nifty specifically, I would look at two stocks in terms of a potential bounce back. The first one which I would be recommending would be from the large cap arena. It would be a buy Axis Bank, a stock which has done reasonably well over the past few days. Looks attractive at current levels of 1020 thereabouts. So would look out for targets in the range of 1040. Stop loss could be kept at 1000. And the second would be a one SBI Cards. That's an interesting chart. The stock has been relatively very strong. It's been trading much above its longer term averages, a consistent pattern of higher highs and higher lows. So I think I read 30 plus levels would suggest a buy with a target of 880, stop us at 816.
Right. Naresh, what about your stock ideas this morning?
So first would be a buy on Kotak Bank. The stock has shown relative strength, and 1880, 1900 has been a support in the near term. So expecting a bounce back here and leadership from the stock. Stop loss at 1870, target price of 2000. Second would be a sell on Dixon Technologies. The stock is yet not broken down, very close to a breakdown below 13,500, 13,800. So a risk reward trade with a stop loss at 14,200 and a target price of 13,000.
All right, guys, now let's talk Titan. And, it's important that Titan, in a sense, is a stock which has come up on Goldman Sachs report. They've added it to their conviction list. And I think in a day or so, you also would get their update or their monthly update in terms of how the gold demand is moving. Now for Titan, what we've seen is that the margins in a sense have been slightly vary because the consumption or the sales which were coming from diamond, which is the solitaire diamond, because of what is happening in terms of a change in terms of preference to lab grown diamond, that has really impacted the aggregate margin picture per se. But given that the competitive intensity in the jewelry space is now reducing, we've had some issues one after other when it comes to the listed jewelry place. First it was PC Jewelers, and then it is now Senco. What is happening there in terms of disclosure? I guess somewhere Titan in a sense will continue to command this kind of an premium. The stock has done nothing. The gold demand is decent. The margins are okay. And given that there is very little choice now left in the listed jewelry market, I guess somewhere Titan really could be a disproportionate beneficiary. I mean, to keep it very simple, if gold prices are higher, margins will be higher. We've had a very long festival season this time around, or very long wedding season this time around, and that I think is something which will also get captured in the numbers for the quarter gone by.
Okay, that's that on Titan. The implied open sitting higher by about 78 points. So mildly positive start, at least, is what we can play in for this Monday morning. We'll take a very quick break. But speaking about precious metals, Jim Rogers spoke about why he likes silver. He's not in favor of adding positions to gold at this point in time because he finds it already very expensive.
I will not add to my gold. Silver is down, gold is up, so I will buy more silver. I do like commodities. Agriculture is better because agriculture is still a little bit depressed. Silver is down almost 50% from its all-time high. Gold is making all-time highs. Both are precious metals and have been for centuries. Gold is expensive. Silver is cheap, I think, I hope.
Back with the market right here on ET Now, and after that relentless sell-off and pain that you saw last week, this morning at least there's some amount of cheer, not just the global markets, but it seems like we're headed in for a slight bit of bounce. Fingers crossed on whether it's going to sustain or build on, or is that uptick going to get sold into, who knows. But Varun is here to highlight all the stocks in news this morning.
Okay, let me start with MOIL because the company has actually increased the prices of its products by around 6.5 to 10% across products. So just keep an eye on MOIL. Also, the production data for MOIL has been good because the February production data, it has been best ever February production For Magnus O, that is 1.53 lakh ton that the production that the company has done. NMDC, the monthly production data and sales data has come. The monthly production data has gone up by around 17.9%, but the sales in the month of Feb had actually come down by 0.25%. Coal India, the production for the month of Feb has gone down by around 0.9% YOY, and also the company has waived off coverage charges for non-power consumers. So keep an eye on Coal India on this news as well. Dalmia Bharat, the company is adding capacity in cement, and also the company is adding clinker capacity in Belgaum and Pune, and the total capex that the company is going to do is 3,520 crores. NCC, the company has received around 219 crores of order in the month of Feb. This is the update that the company has given. Ujjivan Small Finance Bank, the company has sold 364 crores of NPAs to ARC, and the consideration for which the NPAs have been sold is 34.3 crores that the company would be getting. Keep an eye on Paytm because the company has received show cause notice from Directorate of Enforcement, Government of India. The allegations against the company are regarding compliance to the FEMA regulations in relation to some of the acquisitions that the company has done earlier. The company says that there is no impact on this matter on Paytm services to the consumers and merchants. But yes, keep an eye on Paytm because that could be a sentimental impact. And also keep an eye on Ashok Leyland because Delhi Transport Minister has said that Delhi to get over 1,000 electric buses this month. So this would impact Ashok Leyland as well as other EV bus makers. So keep an eye on Ashok Leyland as well.
Well, let's also go to Ashesha, and Ultratech has had a big analyst meet. Why is crucial? Because I mean they certainly said cat amongst the pigeon 2 days ago, and when they said that we are likely to move into the wire and cable foray. So for more details on what exactly brokerages are making of Ultratech Cement, let's go to Ashesha.
Well, yes, some important management commentary that has come in from the management of Ultratech Cement with respect to their foray into the wires and cables business that was announced last week, and they believe that there is enough room for all the existing as well as the new players to grow. In fact, they clarified that there will be no pricing pressure even if Ultratech Cement enters into this particular space, and they say that they did evaluate a couple of other ancillary businesses as well, but they believe wires and cables business will best supplement their existing portfolio. In fact, they said that they evaluated other businesses such as pipes, tiles, wood adhesives, sanitary fittings, lights, but they believe wires and cables best suits the current existing product portfolio that Ultratech Cement is working with. In fact, they also clarified that they will not look out and venture into other businesses other than wires and cables unless it is extremely attractive. So very good clarification that has come in with respect to venturing into other businesses. The plant, of course, will go live in December 2026. As far as return profile is concerned, they are penciling in return on capital of about 20%, IRR of 25%, and EBITDA margin profile will be in line with existing industry peers, and they are expecting to generate 60% revenue from the wires business and 40% revenue from the cables business. Initial capex will of course be about 2,000 crores as highlighted by the management earlier as well, and they will not be infusing any additional capex until the plant comes on stream, which is in December 2026. As far as existing cement portfolio is concerned, that continues to remain intact. They believe that there will be no impact whatsoever with respect to the current cement business profile. They are looking to increase their capacity to 182 MTPA by FY25 and 209 million tons per annum by FY27. So that's the clarification that has come in from the management, that there is ample room for all the players to grow and there will be no impact whatsoever on their existing cement business.
Okay, that's Ultratech. Lots to talk about given the shake-off that they actually, did with the entire wires and cables space as soon as they announced their entry, even though the markets didn't like this diversification out of their core business. But it was a mixed set of sale for auto players in the month of February, with Escorts Kubota seeing a surge in the tractor sales, while Tata Motors, Hyundai all seeing a dip. What are the other trends? Shrishti is here with the summary.
Well, certainly we have seen a mixed sales trend in the month of February itself, but if we have to call out a clear winner amongst the rest, then that will be the tractor sales division, wherein M&M as well as Escorts both registered a double-digit growth, and not just that, they are anticipating this growth momentum to continue in the times ahead with good sowing season as well as good reservoir levels helping the sales data. So great set of numbers from the tractor division, but other than that, within the passenger vehicle segment, we have seen a mixed trend, though M&M of course was the clear winner, but the sales were actually in line to the estimates. A 15% jump on a YOY basis is what the company has seen, while for Tata Motors as well as Hyundai, the sales data was actually disappointing and below the street estimates, while Maruti Suzuki numbers were in line. Talking about the two-wheeler segment, very big disappointment coming in from Hero MotoCorp. Yet again, the company has disappointed on the sales data. It's a double-digit decline on a month-on-month and on a YOY basis, while on the other hand, Eicher Motors Royal Enfield was seen to be taking a lead. The numbers yet again above the street estimates, while the TVS Motors number came in line. Within the commercial vehicle segment, seems like that the recovery will take a little longer because it's the second straight month on the trot. What we are seeing is that the numbers were below the estimates for likes of Eicher Motors VECV as well as Tata Motors, which have come out with the numbers. So we can call it a mixed sales trend in the month of February, but tractor of course was the clear winner this time. Back to you.
Okay, tractor the clear winner. So that could be looked as a positive sign that there is definitely that rural recovery which is at play. We'll discuss all of that. For now, we're going to take a very quick break. The Nifty implied open is picking up a little bit further. We're holding up a good 100 points.
All right, Sandeep Sabharwal joins us now. Last week was bad. Will this week be better? Now that is hope, Sandeep. Will hope turn into reality?
I think the weekly prediction that turning out to be very difficult given the relentless selling we have seen from foreign investors. So I think it's become more technical in nature, where valuations are very much reasonable, and many stocks and companies which are doing very well also have corrected significantly from the tops. But due to the entire fund flow picture, and that combined with post selling on the margin trading facility, etc., traders, has created this kind of fall in the near term. However, I think from my perspective, as I see the markets, I think valuations seem very reasonable. Even the sell-off in small caps and mid caps has reached a level which has been the typical level of most severe kind of corrective moves in small and mid caps historically. Give and take 2-3% here or there. So, like I said last week, that we have gone fully invested. So we are not keeping cash at this stage, because in my view, the risk reward is for a potential 25% upside to a 5% downside.
Interesting. The first one perhaps to come on camera and actually say that they're fully invested now given the steep fall that the markets have had. But guess what? Even as FIIs continue to exit Indian markets, Commerce Minister Piyush Goyal has reiterated that domestic markets are reasonably valued. Let's hear out his comment on the markets.
METTLE, companies with capacity who with genuine worth for the valuations that the market gave them, have still maintained reasonable pricing. Maybe some of them may have seen some downfall, but by and large, the Nifty still reflects decent valuations. I don't know what's the latest forward earnings, what, 18, 19 or 20? 19. So one would say for a developing or the world's fastest growing nation, it's still reasonable. Maybe some small correction here or there may still happen.
Okay. Sandeep, the problem in the market is technical and P/D rating. Now, fundamentally, we can say that this market does not lack good news. Auto sales were decent, GST numbers were strong, GDP seems to be bouncing back, earnings were not that bad. So one side you have the fundamentals which are moving on your side. The other side, you have flows which are completely against you, and the technicals which are just not strong and supportive. How will things settle? I mean, could it get really bad before it gets better? Can the technical sell-off really become more like a tsunami before it gets better? Or the sheer fundamental news will keep us at bay?
Well, my analysis of whatever the markets are showing, the sentiment, especially what we saw last week, where on Friday I got so many queries that should we just sell off our entire portfolio and remain in cash? And that combined with the fact that the valuations are now below historical valuations at a time when we are actually in a monetary easing cycle, not a monetary tightening cycle. So typically, derating should be an acceptable thing when we are in a monetary tightening cycle because the risk-free rate is going up, and as such, the valuation should come down. So that is not the case today also. So the tsunami of outflows out of India and some other Southeast Asian markets, if you see some markets, although many people out here don't track, but if you see what's happening in Thailand, Indonesia, etc., they have also seen similar kind of falls, and in some cases even more severe than India. So it's sort of a global phenomena. India took a bigger brunt initially, I think, because of the capital gain issues, etc., which is not there in some of the other countries. But that said, I think tracking funds flow to make predictions on the market and then deciding your investment strategy is a wrong strategy, because let's say you were in a year like 2007 when there was a tsunami of money actually coming into the country, but valuations were absolutely crazy and out of sync with reality. Then would you just rely on that to make an investment decision on what's going to happen in the next year? So that the answer is no. So you need to buy when you think you're getting stocks or sectors or companies which you think are reasonably valued, and then wait for them to perform. That's the only way.
Interesting. Sandeep, bank seems like a consensus trade right now. Everyone's saying valuations are cheap, that's where the growth is going to be. Where within the banking pool have you added positions or bought afresh?
Among the large banks, like initially we bought into Kotak Bank expecting the resolution of RBI issues and turnaround. So that's outperformed. So not bought that recently, but I think Axis Bank is something which I like at the current prices. Like ICICI will continue to do well. It's a core holding, but then on pure valuations and the kind of risk management that the bank is showing to control its overall asset quality, plus the valuations, I think Axis Bank is pretty well placed as far as large banks is concerned.
Is that the reading on the charts as well? Is Axis looking like the strongest of the lot to bounce from here?
No, I think Kotak is the strongest, which is looking attractive. So when a stock doesn't participate on the downside and when it does best on the upside days, that's what we call as relative strength outperformance. Kotak Bank has exhibited that. HDFC Bank is also showing those traces. I think in the last 1 week or so, the stock has been more sideways, trying to just about shield itself from the market correction. The indicators have started to get back into a positive territory for HDFC Bank, about that 1700 plus mark. And yes, even Axis Bank at 1020 plus levels is amongst the third, stronger private sector banking names, which is looking attractive. The only concern with the, the other name, which is ICICI Bank, is that the stock has broken below its longer term averages. So at a point where many of these stocks are making a bounce back or showing signs of reversal or a positive uptrend or at least stabilization in terms of price trend, that's the time when ICICI Bank is showing relative underperformance. So that I believe could probably take some bit of more time for it to correct with respect to the other private sector banking names.
In fact, Manish Chokhani as well was, pretty much opining the same. He's talking about how he finds merit and value right now in financials.
Good which has become cheap, which we've spoken for some time, has been financials. And while last year we went and participated a lot over the last 2 or 3 years in capital market type financials, I think the time to come back to not only NBFCs but also some of the private sector banks which hadn't performed for some time. Like you would have seen, even in this kind of big sell-off, it's the erstwhile favorites HDFC, Kotak, and Bajaj Finance which have come back. Whereas in the 2-3 years prior, we had leaned very heavily into public sector banks, for example, because of just how cheap they were. So while that trade is realigning back to the better quality, better run financials, market is going to consolidate into the better and better and better well-run financials. So I don't think people have as yet realized, the mega theme which is playing out in financials, because we got sidetracked by the fact that 3-4 of these good companies went nowhere for 4 years. But the time I think for leadership to re-emerge back with the well-run financials is very much here.
Okay, that's Manish Chokhani talking about why he likes financials. But of course, we've got that mega voice, Chris Wood, coming up at 9:30. A lot of sectors he's spoken about. Of course, he's touched upon financials, whether he sees more selling in SMIDs coming in or not. His erstwhile favorite, real estate. Does he think after the recent correction there's opportunity in there? And what is it that he likes from the entire travel/hospitality space? We'll talk about all of that at 9:30 a.m. today. Sandeep, what about real estate? It's corrected a fair bit. We have seen sort of petering down in the realty sales as well coming in. But do you think right now is the time to build maybe a basket of stocks within the realty names?
So the stocks have corrected out there, but I would say in line with the mid-cap side of the market, not excessively vis-a-vis that. And there is a very realistic possibility that real estate sales will slow down, at least this year, given the fact that they continued to grow when the rest of the sectors were not doing as well. And like you rightly said, that recent data also indicates a petering of sales. And typically when that will happen, the pricing power also reduces. So possibility of discounts, etc. increases. So my guess is that next 1 year will be a phase of consolidation for the real estate sector rather than there being significant upside opportunities. Obviously, if the overall market bounces, these stocks will also bounce. But we need to be cautious near term unless we are finding some compelling value in some stocks, which we need to do stock by stock. So I have largely kept the sector on the sidelines and not looking at it in the near term. But potentially at some stage, there will be opportunities.
Look at the selling, man. I mean, Friday's selling was intense to a different level. And Adani group of stocks, the real poster boys of 2001, 2, 3, even 4, they've just gone to cleaners. 50-60% fall is the average fall in any of the Adani group of stocks. That's Friday's data. I mean, Friday they were not on the butcher block, so to speak, but the curve for some of these stocks. 2100 for Adani Enterprises. Where was Adani Ports? I don't want to even guess it. 1600 has become 1100. Adani Energy, without even looking at it, I'm sure it's down more than 50%. Look at the collateral damage which has happened in some of these stocks right now. The other big, casualty in a sense has been Jio. It is all hope, hype, no earnings. It was crafted with the vision that it will be the financial services arm for MDA Group or Mukesh Ambani Group or the Reliance Group. 388, whoa. 388 has become 207. But I'll tell you the wonder boy on Friday. Look at HDFC Bank. And this is interesting. Friday's market action was nothing short of scary. But HDFC Bank on Friday closed in the green. Hello, sir. What a move. Ulta gaya. I think it was the only gainer in the Nifty.
There were few. I think there were a couple of more. But I think HDFC Bank was positive throughout the day. Yeah. So it was not that the stock was impacted first. Yeah. And then it recovered. It was positive throughout the day. It remained sideways.
Sandeep, the general perception is that FIs are selling, they will sell what they own. And they should sell HDFC Bank, they should sell Kotak, they should sell IT. IT stocks in last 1 year have outperformed despite FI selling. And HDFC Bank now seems to be doing higher in a meaningful manner. Why is that FI selling is not impacting this erstwhile favorite?
My guess is that HDFC Bank is not bearing the brunt of selling because in financials are being seen as sort of a safe haven trade right now. Like normally financials are not, but given the asset quality and potential recovery in earnings over the next 2 years, as the name pressures play out and moderate, is what the people are seeing in financials. But I think in the last week or so, a majority of the selling could actually have been in the IT sector. If you see the kind of sell-offs which we have seen in the large cap IT stocks, Infosys, TCS, etc. I think TCS declined just 15% in the month of February itself. So my guess is that last few days, vast majority of the selling has been concentrated in IT stocks.
And IT stocks have gone down when rupee has been weak. IT has been going down when US economy is doing well. IT is going down in general where the mood point clearly seems to be that if US does well, IT should actually do well. And so Sandeep, that's the point, right? The indicators for IT are not bad. The macro indicators, America is doing okay, more outsourcing. Rupee is weak, that means more gain and more margin expansion for some of the IT stocks. So shouldn't they be going the other way because of this macro setup?
A lot of forward indicators of the US economy are actually showing a significant slowdown building up. If you see the the consumer sentiments data, if you see forward US corporate buying, like their sentiment data, like in the near term has suddenly turned adverse. It could be because of all the tariff news going around and companies and consumers being uncertain of various things, or just because it's done so well over the last few years that there seems to be some ebbing of the momentum. So I think that those data points as they started to come out, I think that is the thing which actually has created the recent last few days fall in IT stocks. So I think we need to see the commentary of IT companies post March results, whether they are as bullish as what they were in January. So some uncertainty seems to be coming around the US economy now.
Would you say the same, Sandeep, about pharma as well? Or do you think some of the pharma plays would be safer with not so much of an impact of tariffs or US's positioning?
The X of tariffs, pharma sector as a whole is very well placed because growth has come back, margins have improved over the last couple of years, and most of the pharma companies are actually doing well. And despite the kind of performance we've seen from a majority of the pharma companies, the valuations are still reasonable. The only joker in the pack is the entire tariff thing, because what tariffs will come, when they will come, is something which we don't know on pharma, and most of the companies with significant presence to the US would get impacted near term. But the counterpoint is that the demand for pharma is not going to fall just because prices move up, because these are essential products. So I think so there could be a sentimental up and down, and many of the stocks have also corrected. So I would think on balance, pharma sector is reasonably well placed.
The logic is very simple, that the US economy is growing at 3%, the US healthcare cost is growing at 7%. The healthcare cost for an individual in US in 1980s was $100. Even if you put in inflation and growth and everything, today has gone to $15,000. Indian pharma already has a 10% tariff. If you increase it more, Indian companies will pass it on, because generic now accounts for nearly 90% of the total sales, and within that I think the Indian market share is about 35% broadly. You increase the prices, that goes against what Donald Trump is trying to do, because he's trying to bring the total cost down so that the deficit comes under control. Second, change supply chains. If you keep on changing supply chains, 3 years to 5 years is the minimum time required for any pharma factory to move from India to China or to some other country. So it's not that tariffs are not coming somewhere else, it's just that Indian pharma is competitive. And if you put tariff, the impact actually would be going there. And that is where I think maybe in the run up to the tariff picture, which is for India, it will only come in April. If pharma stocks, and especially the Aurobindo Pharma or Dr. Reddy or Cipla, Lupin, companies which are based out of which get 35 to 40% of the total business from US, that really could be a trade. So out of IT into pharma, I think that's one neat trade. Where you need to look within India, out of EV back to classic, that's another neat trade. Second neat trade is out of to some large extent out of lot of consumer names, but back into some of the consumer discretionary names. I think that's another neat trade. And within banks, Sandeep, while everybody is saying NBFCs, I would say why not go for NBFCs, the point which you've been making now. Because if the tightening is being taken care of and more liquidity is coming in, MFIs and NBFCs would be the first one to bounce back.
Yeah, so I think it's often not understood and within a lot of investing community that the bulk borrowers, the NBFCs, are bigger beneficiaries of monetary easing and improved liquidity because they don't have the CASA deposits where the cost remains more or less fixed as in the case of large banks. So NBFCs actually tend to see improvements while in the initial phase of rate cuts, banks actually see some pressure on their margins because the cost of deposits does not come down while the rate at which they are lending comes off because of rate cuts. And with this risk weight cuts also, which the RBI announced, a lot of things are falling into place for NBFCs. So I would agree that large NBFCs with a strong capital base, possibly corporate sponsored, etc., they could actually do better than banks on absolute return basis.
Sandeep, what is it that you're making of, the auto sales numbers? I haven't discussed that. Tata Motors, of course, most segments are seeing a drop. I guess the markets already, saw that coming. Similar is the case, a drag coming in for Hyundai as well. Hero MotoCorp, weak set of numbers. Total sales are down 17%. Maruti, again, the sales have managed to miss the estimates there. The entry-level segment is what is actually seen a drop. But it's the tractor sales which have done very well. And for M&M, both auto and tractor sales have been higher than estimates.
M&M has been the standout performer. Maruti has done reasonably well. TVS Motor numbers were good. Hero MotoCorp has a habit of putting in a lot of inventory into the system with the dealers and then adjusting. So their numbers sometimes tend to be haywire. But a lot of fear was there in the last couple of weeks that auto sales are just falling off the cliff and auto sale numbers are going to be very bad. Actually, the numbers don't reflect that. I think the numbers have held up pretty well. So, and the auto stocks have also corrected significantly. So I would think that M&M continues to be the best stock, and it's also fallen from the top pretty sharply over the last few days. Even Maruti, Bajaj Auto, many of these companies look well placed. Even Tata Motors, although we don't own it right now, at 600 odd rupees, I don't think it's an expensive stock.
Would you buy Tata Motors or you already have bought?
No, not bought in the recent past.
Okay. What about two-wheelers then, Sandeep? Because, that's where all the confusion comes. We discussed Hero MotoCorp. TVS numbers, of course, are quite okay. Awaiting Bajaj Auto's numbers, though.
Yeah, so on valuations, all two-wheeler stocks are cheap now. Like TVS always remains a bit expensive, so it's still expensive. But I think Hero MotoCorp, Bajaj Auto, both look very cheap relative to fundamentals and the fact that rural demand is on a revival cycle and monetary easing will, along with the tax cuts announced by the government, will have a positive impact on durable demand as well as so on the auto side, it has a better demand impact on two-wheelers rather than four-wheelers, which are more costly. So I would think that valuations have adjusted significantly and valuations are very, very reasonable.
Interesting. Sandeep, good to have you on the show as always. Thanks for your time today. Okay, let's move on. While we await the pre-open rates, the GIFT Nifty is indicating just a very mildly positive start, much unlike what our global counterparts have been up to. But let's get in some, trading strategies from within SMIDs. Kunal, what would you have from within mid-cap ideas?
So there'll be a Ban Shriram Finance, a very interesting chart. The stock in the last few days, especially with the news flow surrounding the stock in the MFI segment specifically, I think we've seen a good pickup of price action. The stock breaking past about the 600 levels, and also a slew of resistances in terms of the previous swing highs for Shriram Finance. So that makes the stock a little bit more attractive with respect to many of its other peers over the short term. Buy with a target of 635. Stop loss could be kept at 608.
All right, so that's a buy coming in on Shriram Finance. So let's watch out for that. But Naresh, what about you?
So that would be a buy on Indigo. The stock has clearly shown relative strength, making slowly higher tops and higher bottoms, setting up for a fresh breakout towards the recent highs of 47, 4800, a stop loss at 4400 and a target price of 4700 in the extreme short term.
Okay, let's move on now and